Want to know how to be a successful investor? The answer is stay with what you know. Don't listen to me. Don't listen to TV people, internet people. Just stay with what you know. If I told you you can only have 20 investments in your life, you would be very careful. You wouldn't be jumping in and out, listening to hot tips every day, every month. You would stay with what you know and you would become a successful investor. Everybody watching this knows a lot about something, whether it's fashion or cars or sports or something. When you see something that you know is going to be successful and exciting, don't just say, oh, that's going to be great. Don't tell all you. Then you go and you do your research and you figure out how to and if you should invest and how to invest, and then you invest. You will know it long before I will, or long before other people in the investment community. You will also know when to sell, because you will know when something's going to change again. Nobody likes to hear it. Everybody wants a hot tip. Everybody wants to be rich this month. In those days, we did nothing but focus and concentrate and dig deep and dig deep and dig deep.
Hi there, Greg.
He called the fall of Lehman Brothers 5 months in advance, as well as the Bitcoin crash. And now on October 19th, this expert analyst is stepping forward with his biggest and, quite frankly, scariest prediction to date. Warning that a massive market event nobody sees coming will surprise most investors and ruin the retirements of millions of Americans. If you don't fully understand what's happening, every dollar you spent your life earning, saving, and investing could be wiped out in the coming weeks. And according to his research, it might never recover. And so, on October 19th, he's revealing the details of this big prediction, as well as the name of 2 major companies you likely own, which he warns you need to sell immediately. Best of all, he's sharing all of this with you 100% free. For more details and to sign up for this event, simply go to nextmarketmeltdown.com. I know I'll be tuned in to see this important information. Again, that's nextmarketmeltdown.com. Hi, this is Daniela Camboni, and welcome back to the Daniela Camboni Show here on Stansberry Research. Well, we saw the headlines. A hot inflation report means we should be expecting a more aggressive Fed and a likely recession. Here to talk about all this and more is Mike McGlone, a commodity strategist over at Bloomberg Intelligence. Mike, always good to see you. Welcome back to the show.
Well, hello, Daniel. Thanks for having me back. It's good to see you.
Yeah, well, we're going to talk about a lot of good things and not so good things. But let's start with your take on the latest inflation numbers coming from the Fed. Obviously, another 75 basis points on the table, right?
Yes, it's hard for the Fed to be much more aggressive than they are. Some measures say that it's the most aggressive they've ever been, certainly on a global basis with other central banks playing catch up. We've never had more central banks hiking rates at the same time. At the same time, the world is clearly heading towards a recession, definitely in Europe, China potentially, likely, and U.S. very likely. And particularly with numbers like this, it's keeping the Fed pounding hard, yet everything's tilting towards recession. So it's a 1929-like scenario.
Well, you know, you saw the headlines, Jamie Dimon, Ray Dalio, Druckenmiller, I mean, all these Wall Street gurus really coming out, like you said, sounding the alarm about this economic hurricane. Jamie Dimon saying recession likely in the next 6 to 9 months. What's your take on his timing? Is that accurate?
Yes, I think we're getting to catch up with the mainstream. I was early and wrong initially predicting this about a year ago. Don't fight the Fed was my main theme this year at the end of last year. And now the mainstream's getting it. So I think that means we're clearly in a bear market in equities. In gold, no, I don't think it's a bear market, and potentially in commodities. And any big rally should see responsive sellers. But that's what you expect in bear markets. Rip-roaring rallies, rip your face off, and bear markets take money from everybody. So I think that narrative is now mainstream. It's just a question of how much volatility there will be and what can save us. And that's my key theme for literally the last almost 3 months is I don't see what saves this ebbing tide of global risk assets, most notably where all correlations are now starting to head towards the S&P 500. You look at the charts now, even crude oil and commodities are all following the stock market lower, and they're catching up because they spiked earlier. And gold is too. I mean, even bonds, everything is. And the question is what comes out ahead. And I'm been early, but I'm sticking with my thesis that we're heading towards a significant deflationary recession, which is way overdue. That'll be enduring, and potentially an enduring peak in equities and commodities. And the assets will probably come out ahead, I think, will be eventually U.S. Treasury long bonds, Bitcoin, and gold. I mean, I look at this 2-year note; it's pumped up to near 4.5%, and that's just guaranteed 9% over 2 years, not including compounded returns. And in a world that's heading towards recession, that's just way too attractive, which is a problem because it keeps the dollar strong, which is bad for overall commodities.
And all very good points. And I just want to hone in on what you said there. And what I'm understanding is there's no safety right now. There's no safe play.
There isn't, except being long the dollar if you're in other countries, or short the market, or cash. And now that U.S. cash, I refer to the two-year note, is so attractive in a global deflationary environment. Now, yes, inflation has been high, but I will, by the time this airs, I'll be publishing an update to my commodity and inflation outlook, where your typical indices and typical measures use 12 months. Well, I use 120 months. And it shows we are really tilting aggressively towards mean reverting lower. If you follow commodities over PPI, they are spiking, and the peak this year is actually below that of 2008 in terms of inflation. And it's just looking at the macro bigger picture that I fully expect. When we're speaking this time next year, it's going to be about enduring inflation. The difference this time versus almost our entire lifetimes is the Fed will not ease as easily as it did in the past. That's the big difference, and I think most equity investors are getting it. That's where I think gold's going to come out ahead along with Bitcoin. We're going to get that deflation. We're just not going to get the easy money until the whites of the eyes of a clear global recession are in our faces, unfortunately.
Wow, but you think all that could change in a year? Only
well,
a
at
year's
least,
time?
well, not, I mean, by next year, this time, I think the market will figure it out. So here's my base case scenario. I've already talked about that global recession, and this is not, when we talk about it 8 to 10 months ago, is kind of, it was the idiot factor, so I'm less of an idiot now. But it's what we should expect now is inflation to decline and expectations for inflation, to actually inflation actually start underperforming expectations, which will be because of a global recession. But the markets, I think, will initially take that as a relief because they'll say, oh, inflation's dropping, the Fed doesn't have to tighten anymore, doesn't ease, but I think inflation is going to plunge and go back to where it was well before COVID because of recession. And there's one basic key bottom line economic indicator that's always been proper and right about inflation. That's monetary supply, the simple lessons of Milton Friedman. So we have some measures. You look at U.S. monetary supply, M2, it pumped the most ever in 2021. It's collapsing. If you look at global measures of money supply, our measure we have in the Bloomberg Turbo on a 12-month basis is plunging at about 5%. That's the most ever, and it completely exceeds that of the global financial crisis. So
but it's taking time.
Oh, yeah. So
you're going to see it yet in the inflation up. Right.
It's a lagging factor. And this is the key thing I missed. We got the inflation later than I thought. I thought we weren't going to get it, so I missed that. But now that pendulum is swinging so hard, hardest I've ever seen it, and central banks are pounding so hard, it's the lagging factor, and it's just inevitable. The key question is what stops this? It's certainly not going to be the Fed.
Okay, let's talk gold a second. I read with great interest an article from Bloomberg actually saying how gold's really moving from west to east, that Western buyers are dumping gold, Asian buyers coming in, swooping it all up. I mean, on the counter argument, I would say, well, why are premiums so high here? And demand, it just seems impossible to get a hold of like silver and gold coins. because of demand from North America. I mean, what are you seeing here on the gold front?
To me, it's much more the macro, and I appreciate you digging into the weeds. The number one thing to remember about gold is it's doing what it has been in the past. It's made a new high in terms of the euro and the yen and virtually every melting currency on the planet except the dollar or maybe the ruble. And it's a matter of time it does in the dollar. So gold's doing what it's supposed to. It's underperforming the dollar. Remember, what's leading this pressure on gold is the most aggressive Federal Reserve rate hikes that, since the 80s, for good reason, but it's fighting lagging inflation. And I have to open crude oil, and I'll get you there in a second, but I fully expect gold, this pounding of the sledgehammer from the Fed is it's bringing out the responsive sells in equities, but I think it's building that base in gold. Now, I didn't think it gets much below 1,800, and here we're close to 1,700. And I think it's just a matter of time that once we get to this delayed deflationary outbreak, gold will break out. But the key thing to note here is one of the most significant global mean reverting assets, crude oil, spiking early in the year was part of the reasons the Federal Reserve and central banks accelerated the rate hikes. Now that mean reverting asset is doing what it always does, it's collapsing. So I think that's going to happen. We're going to go back to that normal trend.
What about the strength of the U.S. dollar, though, Mike, and this pressure on gold?
So that is a problem. So that's in terms of dollar-based gold. What's the key thing that's driven the strength of the U.S. dollar for the last at least 10 years is the U.S. stock market outperforming the world. So that's part of the lose-lose for the U.S. stock market. At some point, that's going to give up, and it's a question of when, and that's one thing the Fed's fighting. We need stock market to go down for inflation to go to alleviate the ability for people to buy stuff, as Jim Bianco says, and that's part of the lose-lose. But in terms of dollar price gold, it's still a headwind, but it will go away, just a matter of time, and gold will outperform, and I think in terms of dollars. But remember, in other currencies, gold's doing what it should be doing, and it's protecting wealth.
And to that point, you said, when I spoke to you a few months back, once gold hits 2,000, it's not going to look back. Are you sticking to that thesis once it gets that momentum?
Yeah, so I didn't expect the Fed to be this aggressive in the rate hikes. I didn't expect crude oil to pump as much as it did, but now everything's reverting, and that's going to mean to an enduring base in gold. So to me, when gold gets above $2,000 an ounce, I didn't say if, it's just a matter of time, it should stay above there forever. I mean, it should put that in enduring bottom. But what we need for that to happen, Danielle, is this transition towards what I think will be that enduring deflationary period, which is a matter of time.
I got to get some thoughts from you on Bitcoin, because I always say you're one of those hybrid guests that has embraced gold and Bitcoin. You're very bullish on Bitcoin in the past, saying, you still saw 100,000 in its future. As we're speaking now, we're hovering around the 20,000 mark. Thoughts on Bitcoin and its next stops here? Where do we go from here?
So Bitcoin, I think it's a matter of time it appreciates towards that $100,000 level, and at some point it's going to just flip in and kick into that bull market. Maybe at the same time gold and treasury bonds do in terms of price. The key thing right now, it's getting pounded, but it's one of the most discounted it's ever been on a 100-week and 200-week moving average, and it's simple facts of supply, demand, and adoption looking forward to the next 5 or 10 years. Supply is going down by code, demand and adoption are going up. Now, you cannot really say that about virtually any other asset on the planet. That's also in early days of an adoption. So the world's going digital, and this is a benchmark digital asset. So to me, it's a matter of time, and let's look at relative price. I think Bitcoin's building a foundation around 19 to 20,000 like it did around 5,000 in 2018-19. It did get as low as 3, and here we are, 19,020. So that's what Bitcoin does. It only goes down after it goes up a lot. Something has to change that narrative, but the world is gaining adoption in that space. And it's also, I just came back from the WebEx conference in Las Vegas, and it's what you see is the typical, what I expect is people know this is the fastest horse in the race. It's the most advanced, it's the rapidly advancing technology. You can't fall behind, and you need to be part of it. And it's still such a small portion of global investable assets. And I'll leave with this as far as Bitcoin and Ethereum and cryptos is there's lots of speculation, but one thing that this space is doing, Ethereum, is making possible this new technology where the most rapidly trading cryptos on a planet is the dollar, tokenized dollars. People are just starting to get that. U.S. regulators are just starting to get that. And the fact that China pushed back on it is also another reason it's going to be adopted in this country. It has in Canada. It's just a matter of time. So that's, again, it's supply, demand, and price. So here, let's just compare that to crude oil. Supply, demand, and price. Crude oil is being replaced by technology. It's the same price as it was in 2007 for a reason, because we create more of it, we use less of it, and rapidly advancing technology is the reason.
So what I'm hearing from you is regulation, which inevitably looks like it's coming for Bitcoin, will be healthy for the space, because there's two ways to look at it. I speak to some folks who say, well, the U.S. is going to regulate it because they're not going to want a competitor to its eventual digital currency. And others say, well, they will regulate it, but it won't hurt Bitcoin because they're not going to want to lose the race in blockchain technology. Your thoughts? Where do you stand here?
The U.S., I guess a bit of an optimist, is not dumb enough to acknowledge this is rapidly advancing technology. And as I pointed out earlier, this technology has adapted the dollar as its base foundation. Like I said, the most widely traded cryptos it's not Bitcoin, Ethereum, it's the dollar, tokenized dollar. So U.S. is getting it. It has all the key checks you need to pass in the U.S. It has money, votes, jobs, and it pushes back on China, to name a few. So it's not messy. It's a sloppy. It's not clean. It's a messy process, but it's happening. We do have a Bitcoin ETF in the U.S. It's imperfect, but it's just a process of that adoption, and it's just a matter of time. And you look at what it's doing to the world. It's somewhat unstoppable, except in places where you have authoritarian leaders and autocratic systems that can't adapt to this new technology, and that's where it's creating a great divide where places like the U.S. are moving forward.
What about, El Salvador? There's arguments that, they're doing this whole Bitcoin experiment, but they have little to show for it thus far. It's cost $60 million, $375 million was spent. Is that a good base case for other countries, or are things just going wrong down there?
Not yet. Well, it's part of that rapidly advancing nascent technology. It's like claiming Bitcoin's not a good inflation hedge, even though it's the best performing asset on the planet. It's only been around about a decade. It's early days. And I don't know how much you're going to adopt it, but it's one of those things, it's unstoppable. China's tried to stop it, and what happens, most Asians want access to the dollar, and they get it through their phones, through Ethereum tokens or other tokens. So Bitcoin's just part of that space. So I look at the technology, and that's part of the reason. I'm not bearish gold, but you got to have Bitcoin in that space with gold, because it is becoming global digital collateral.
Final thoughts from Mike McGlone. Top of mind for you, what are you eyeing and watching the most?
The base, mostly at the moment, Bitcoin and cryptos have been pushed to the right side. It's the global macro with the Fed and central banks pounding the hardest they've ever done in many cases, while the world's heading towards a global recession, a significant recession. This is like 1929. So I fully expect that gold and bonds and Bitcoin's going to come out of this ahead, but it's that process, and at some point we're going to get to inflection. I'm not saying the Fed's going to ease, because they can't ease like they passed, but get to an inflection. They have to stop tightening because the pressure is so bad that everything's tilting lower, and the question is what stops it. And right now I don't see anything that stops it, and I think it's going to be one of those things that, Danielle's going to take 1 or 2 days. We have a sharp drop in the stock market or something, and then the Fed's out of the picture, at least for tightening. The key thing to remember is they will never ease, ever, like they have in the past, because of the lessons of inflation and too much liquidity. The key thing I'll leave you off with.
No more Bernanke days.
No, not such a Bernanke. It started in 1987. Yeah, Bernanke wrote the book, and the Courage Act, and it made complete sense. They saved the system, but we got way too much easing, way too much liquidity. And the key lesson is you only get dumps, major corrections after you have massive pumps. And we had the biggest pump in history, and now that's dumping at the greatest pace in history. It's slow moving. I'm impatient. It's just going to take time. That's why I point out a year from now, I think the key narrative is going to be deflation and how do we get out of this recession.
All right, Mike McGlone of Bloomberg Intelligence, always good chatting with you. Come back. We'll see you soon.
Thanks for having me.
And thank you for watching. Be sure to stay tuned to Stansberry Research and the Daniela Cambone Show, and to sign up at danielacambone.com so you don't miss all these fantastic interviews that are just must watch, folks. That's it for me. Thanks for watching.